Over the past few weeks, there's been a lot of noise about the housing market. Mortgage rates have spiked, which could result in over 1 million UK families losing a fifth of their disposable income. So, what's actually happening, and how will Cardiff be affected? First things first, we need to address why mortgage rates have spiked. Commercial banks, which are the ones that lend to you and me, borrow money from the Bank of England at what is known as the base rate. As such, the price of the money that they lend is significantly affected by the level of the base rate. Greater costs for banks mean greater costs for borrowers. There are two main relationships between mortgage rates and the Bank of England's one. For borrowers on a variable rate, such as trackers or the standard variable rate, changes in the base rate feed directly into the interest on their mortgage. However, the vast majority of UK homeowners opt for fixed rate deals. These lock interest for an agreed period of time, protecting borrowers from unexpected rate changes. This means that instead of just feeding changes in the base rate through to borrowers, banks have to anticipate the Bank of England's decisions over a deal's total duration. So, both are related to the base rate, just in slightly different ways. In this country, the Bank of England fixes the base rate according to its 2% inflation target. The very basic idea is that the higher the rate of interest, the harder it is to borrow and the more lucrative it is to save. In turn, this reduces inflation by taking money out of the economy and hitting demand's upward pull on prices. With around 90% of the UK's household debt wrapped up in property, almost all of the pain is felt in the housing market. This has come to a head recently as the current bout of inflation has proven harder to stamp out than was predicted even as recently as February. As Bank of England boss Andrew Bailey said in May, the Monetary Policy Committee continues to judge that the risks to inflation are skewed significantly to the upside, primarily reflecting the possibility of more persistence in domestic wage and price setting. This has led to fixed-rate mortgages spiking upwards in anticipation of the base rate going higher and staying higher for longer, leaving families coming off their fixed-term deals facing a cliff edge. Throughout June, the interest on the average 2-year fixed-rate deal has been approaching 6%. For context, this is a level that has only been breached once in the past 15 years, and that was in the wake of the Truss-Kwarteng mini-budget fiasco. According to the ONS, there are around 1.4 million UK families who were on a fixed-rate deal of 2% or less that are having to face remortgaging this year. For the average Cardiff homeowner, a jump from 2% to 6% would mean around £550 to £650 extra in housing costs per month. It is true that rates used to be at a similar level before the 2008 banking crisis. However, houses were also a lot cheaper back then. At the turn of the millennium, before the housing bubble really started to bloat, Cardiff's average home was worth around 4 years of the median worker's salary. Now, after a decade of stagnant wages, record low interest rates, and a policy focus on stimulating housing demand rather than supply, the average house price in Cardiff has risen to about 8 years' worth of income. What we're seeing is a housing affordability interest combination that isn't too far off what we had in 2008. That's not to say that we'll have the same crisis. There were plenty of other factors that were present then that aren't now, but it is indicative of just how unaffordable mortgages are becoming. This affects renters as well. Higher housing costs will, at least in part, be passed on to tenants by landlords, while unaffordable mortgages also drive up demand for rented accommodation. In Wales, rents have exploded, with the cost of the average tenancy increasing by 5% in the year to May 2023. In the decade leading up to 2022, average annual growth was less than 1%. This is especially painful for those on low incomes who often rely on housing allowance, which is a benefit that has been frozen in cash terms since 2020. Recent IFS analysis has shown that just 2.5% of Welsh private rental properties listed on Zoopla are affordable for those that claim the benefit. This is despite these people making up over a third of all private renters. It's also worth noting that rents are likely to continue to grow as more tenancies come up for renegotiation and more landlords have to remortgage. If you or anyone you know is struggling with housing costs, it's worth getting in touch with your local council. They're able to offer advice and, in certain situations, financial support. We'd also love to hear from you. Are you someone that's struggling with interest rate rises? What more would you like to see done? You can contact us via our email or any of our social media platforms.